In this video we are going to talk about the dividend snowball effect. So before starting this video, please like this video and subscribe to this channel for our future updates. A continuous cycle of increasing dividend income is referred to as a dividend snowball. The formation of this capital takes place through the purchase of shares in dividend growth stocks. The dividend income received from those shares grows over time as they are held. The infusion of fresh capital, the practice of dividend reinvestment, and organic dividend growth all contribute to an increase in dividend earnings. Compounding can be thought of as an analog to the snowball effect. It illustrates how relatively insignificant acts can lead to significantly significant results over time. Do you remember when you were younger and you used to roll a small snowball down a hill? This initially modest snowball ballooned into a gigantic snowball by the time it reached the bottom of the slope. Your snowball would gather up more snow and build a bigger and bigger snowball depending on the length of the hill. The longer the hill, the bigger your snowball would become. Dividend. The concept of snowball investment is analogous to the process of rolling a snowball down a hill. If you invest in dividend growth stocks for a longer period of time and reinvest the dividends that you receive, then in a relatively short period of time, your dividends will balloon into an incredible amount. How exactly does the dividend snowball function in practice? Company-operated DRIPs. Only a handful of blue-chip companies that pay dividends operate their DRIPs. Coca-Cola and Johnson & Johnson, for example, both provide their own direct stock purchase plans and DRIPs, which reinvest the dividends that are received on the equities. Third-party DRIPs. DRIPs are sometimes outsourced by dividend-paying firms to third parties or transfer agents. This type of DRIP is referred to as a third-party DRIP. Please be aware that these agents typically demand payment from investors in the form of a fee. Brokerage DRIPs. The vast majority of brokerages and robo-advisors also make investing in DRIPs possible through a straightforward process. You will need to choose dividend stocks to put into the DRIP at your brokerage. Then, whenever you get a dividend payout in your account, your brokerage will reinvest it in new shares of the company. Investing in dividends using a snowball strategy can be executed in this manner, which is perhaps the most straightforward approach. Self-implemented DRIPs. If the dividend firm you have chosen does not offer a DRIP plan and no brokerage or third party additionally facilitates dividend reinvestment, then you are able to directly handle the dividend reinvestment program known as a self-implemented DRIP. You need just reinvest your dividends to buy full or fractional shares for the amount that is equivalent to the relevant amount. Compounding and dollar cost averaging are two strategies that might help you make the most of a procedure that is otherwise more laborious. Steps for dividend reinvestment. Make sure to pick solid dividend growth stocks that have a track record of yearly dividend increases. However, you should be certain that the payout ratio does not get higher than 75%. If the company has a payout rate that is on the lower end, this indicates that there is a greater possibility of future dividend increases. In order to succeed at the dividend snowball game, consistency is essential. Therefore, you should make a contribution every month to purchase items if you receive sufficient dividends. The practice of purchasing dividend stocks on a monthly basis ensures dollar cost averaging, which contributes to a reduction in the short-term volatility of the equities market as a whole. This is one of the most effective strategies for generating a steady income over the course of a long period of time. You can accelerate the growth of your dividends by reinvesting the dividends to buy additional shares of the company. In addition, there is no commission charged when dividends are reinvested, making this strategy a win-win for long-term investors. The dividend snowball approach calls for ongoing investments over a period of time that is typically anywhere from 5 to 20 years. Therefore, the keys to success in this situation are having time and patience. The advantages that come with using the dividend snowball method. There are two key reasons why the dividend snowball method is one of the finest ways to create a stable passive income over the long term. These reasons are as follows. Dollar cost averaging is a feature offered by DRIPs that makes it possible to gradually amass more shares without incurring any additional commission fees. Through their DRIPs, a number of different corporations provide shareholders with the opportunity to purchase shares at a discount ranging from 1% to 10% below the current share price. The cost basis for owning the new shares is substantially lower than that of purchasing them on the open market because discounts and the absence of commissions are involved. Investors have the ability to buy fractional shares through a program called DRIPs, which makes every dividend dollar useful. Compounding returns are the greatest major benefit of investing in dividend growth companies, and they are also the most significant advantage of dividend growth investment. When there is an increase in dividends, shareholders get a larger sum for each share that they already own, which gives them the opportunity to buy even more shares. This, in turn, causes an increase in the possibility of a complete return on the investment as time passes. As a result of the fall in the price of the stock, more shares can now be purchased, which raises the possibility that there will be more significant gains in the long term. How to use the dividend snowball strategy in your individual retirement account. The majority of investors prioritize having a comfortable retirement with a sizable nest egg and spend their entire careers working to build up their asset base. One of the most effective strategies to increase one's income in retirement is to make investments in dividend-paying stocks and use a strategy known as the dividend snowball. Alongside the money you get from Social Security and your pension, the cash that you've accumulated via dividend payments can eventually serve as an extra source of fund flow. When investors put in a small bit of effort, they have the potential to bring in a sizable amount of money via dividend income. People who are seeking to save for retirement can consider employing the method of reinvesting dividend payments into the purchase of further stock. They will eventually collect larger and more significant dividends if they choose to proceed in this manner. Before putting their faith in dividend reinvestment, investors should make careful plans and ensure they have access to other sources of income in the short run. Investors should consider diversifying their retirement investments over a number of different vehicles, including individual retirement accounts, IRAs, 401k plans, and other liquid funds. This goes a long way toward ensuring that the retiree has sufficient savings and is capable of surviving without the immediate cash that is provided by dividends. The dividend reinvestment method, often known as the dividend snowball strategy, is a very long-term investment tactic. Because the majority of dividend earnings are not sufficient to cover investors' immediate requirements, investors are often required to continue reinvesting their dividends after they have retired. The annual income of a retired person will not be significantly impacted by those dividend payments in any meaningful way. If, on the other hand, an investor continually reinvests the dividends they receive each year, they will be able to grow their portfolio without giving up any new sources of income. The dividend snowball approach is one of the easiest and most cost-effective strategies to gradually increase one's assets in retirement accounts over the course of time. Traditional dividend growth equities, such as Procter & Gamble, Gamble and Coca-Cola, are among the most reliable investments for retirees. These stocks typically increase their dividend rates, which helps provide returns in the future that are higher than the rate of inflation. When investors choose to include such companies in their retirement portfolio, they are giving up the current dividend return in exchange for a greater payment at a later date. The majority of vehicles for saving for retirement stipulate that members must begin withdrawing funds from their accounts by a certain age. Therefore, retirees are able to take money out of these accounts after they reach retirement age and use that income to maintain their standard of living. This allows them the flexibility necessary to reinvest their dividends. The dividend snowball strategy has a lot of promise, but it might not be appropriate in all circumstances. In the early stages of retirement, this approach might prove to be the most beneficial option. However, if a retiree has an increase in medical bills or depletes his savings accounts, it is possible that the investment will become less advantageous over time. The effect of the dividend snowball and taxation. An investor needs to be aware of the tax repercussions of the dividend snowball method before they can put it into practice. Because a dividend is considered to be taxable income, the Internal Revenue Service (IRS) will still count it as income even if it is reinvested before being deposited into your account. The classification of dividend income on Form 1099 DIV might be either qualified or non-qualified. It is important to note that dividends received from master limited partnerships, MLPs, employee stock options, and real estate investment trusts are not qualifying dividends. In addition, dividends received from funds and companies based in the United States are considered qualifying dividends. While dividends that are not qualified are subject to taxation at the same rate as ordinary income, qualified dividends may be eligible for a tax treatment more advantageous than that applicable to long-term capital gains. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.